Yes, good evening, guys. So this is Larry B, and I'll be taking you on this course. The topic I'll be taking today is Introduction to Technical Analysis. And one thing you should understand is the fact that technical analysis is actually very wide, and it is also technical as the name denotes. It is very wide. If you are not careful and you don't take your time to understand some certain things, you would eventually have issues with your trades, because technical analysis can be applied into stocks trading, it can be applied into crypto trading, and it can be applied into forex trading. So once you understand some basics in technical analysis, it can be applied to the three, both stocks, crypto, and forex. There are some technical analysis concepts that can be applied to the three, and that is like the basics, like the candlestick patterns, your support and resistance, your trend line. All those ones are like diverse, they cover every other thing. The only difference are all those indicators. Some indicators work with forex, some work with stocks alone, some works with crypto, and some works with the three. So that's just the thing about what they call it, about indicators. But generally, technical analysis is very broad, and you need to understand perfectly. Then you find out the ones and concepts that works for you. And once you find out the concept that works for you, then you are good to go. So the methods that are used to analyze securities, stocks, crypto, foreign exchange currencies, and make investment decisions, they fall into two very broad categories. That is the fundamental analysis and technical analysis. And we covered fundamental analysis before, which involves analyzing the characteristics of whatever you are analyzing, whether it is a company stocks, it is foreign exchange, it is a currency, it is crypto, in order to estimate its value. It is basically, you basically observe based on what people are doing around that coin, or let me just use cryptocurrency. Fundamental basically deals with the information around surrounding that coin, the noise and everything, not necessarily what is on the charts. While technical analysis takes a completely different approach entirely. It doesn't care about the value of whatever anybody is saying, or the company, or the commodity, or the crypto in question. We call them technicians or chartists. They are only interested in price movements in the market. We call it price action. They are basically looking at the chart price movement. That is what they deal with in order to make their own investment decision. So despite all the fancy and exotic tools that it employs, technical analysis really just studies supply and demand in the market and attempts to determine what direction or trend it will continue in the future. It's very straightforward. It is basically the principle of demand and supply that technical analysis works with: support, resistance, demand and supply. If there is a demand for something and the supply is low, you know that the price is going to be high. And if the supply is too much, the demand is most likely to be low, then the price will drop. It's just basic generally. Technical analysis basically deals with demand and supply. There's nothing, every other thing is just grammar. It's just demand and supply, support and resistance. That is what everything still boils down to eventually. So in other words, technical analysis attempts to understand the emotions in the market by studying the market itself as opposed to its components. So if you understand the benefits and limitations of technical analysis, it can give you a new set of tools or skills that will enable you to be a better trader or investor. Learning does not end when it comes to technical analysis. You keep learning, you keep evolving, you keep improving. So you understand. So that is just it. So this night I'll just be covering the basics and providing you with the foundation you need to understand more advanced concepts down the road. So what do we understand by technical? Sorry for the break in transmission. So what do we understand by technical analysis? Technical analysis is basically a method of evaluating what you are analyzing. It could be crypto, it could be a currency. We call it securities. Basically by analyzing the statistics generated by market activities. Market activities such as past price and volume. Basically, you see, whatever you see on these charts are actually prices and volume. It's basically how will I put it now? It is basically what other buyers and sellers have done in the past, and what current buyers, sellers, and investors are most likely to do based on previous information that you see on the chart. So technical analysts do not attempt to measure a security's intrinsic value, but instead they use charts and other tools to identify patterns that suggest future activities. So you go with the trend based on what has happened before. So you understand. So just as there are many investment styles on the fundamental styles, there are also many different types of technical traders. Some traders rely on chart patterns alone. Some people, they use technical indicators like MACD, Fibonacci, and the likes, RSI and co. Some they use oscillators, and most use some combination of them. In any case, technical analysts' exclusive use of historical price and volume data is what separates them from their fundamental counterparts. Unlike fundamental analysts, technical analysis don't care whether a coin is undervalued. The only thing that matters is the coin's past trading data and what information this data can provide about where the coin might move in the future. Do you understand? So it's basically look at the chart to project what the price of that coin will most likely be in the future based on the previous price, the way other traders reacted to whatever has happened in the past. That is what we basically read in the chart. And in the field of technical analysis, it is based on 3 different assumptions. 1, the market discounts everything. 2, the prices moves in trends. And 3, history tends to repeat itself. History always repeats itself when it comes to cryptocurrency trading. History always repeats itself, and price always move in trend, either uptrend, downtrend, or sideways. That is what we call consolidation. So either ways, prices always move in trend, and you as a technical analyst, you are supposed to follow that trend. You are not expected to be predicting it. You are supposed to follow the trend. If you are seeing clearly that this thing is going on a downtrend, you follow it on a downtrend. You trade with the trend, with the current trend. You don't predict. You don't trade against the market. That is just that regarding that. So I'll be breaking down those 3 fields in how will I put it? I'll be breaking them down shortly. When we say the market discounts everything, a major criticism of technical analysis is that it only considers price movements, ignoring the fundamental factors of the coin. However, technical analysis assumes that at any given time, a coin's price reflects everything that has or could affect the company, including fundamental factors. So technical analysts, they believe that the coin's fundamentals, along with some broader economic factors and market psychologies, are all priced into the stock, removing the need to actually consider these factors separately. So as a technical analyst, they believe that all these factors, they work hand in hand. Fundamental factors, economic factors, social factors, market psychology, everything works hand in hand. That is why your trading emotions has to be on point at every given time. You shouldn't be, how will I put it? You shouldn't be motivated, how will I put it now? You shouldn't be motivated by when you win on a steady. You should be careful, so that when you make some certain mistakes, it won't weigh you down and affect your trading style that you've already perfected. Sure, you understand? So you have to consider every other factor when you're dealing with the market. Then the second one, when we say price moves in trends, in technical analysis, price movements are believed to follow trend. They always follow trend. This means that after a trend has been established, whether it is uptrend, downtrend, or sideways, the future price movement is more likely to be in that same direction as the trend than to be against it. So you are not expected to trade against the trend. Do not trade against the market. If, for example, you are saying that BTC is constantly going on an uptrend, then you now enter the market and you are shorting it, predicting that the price will go down, when clearly everybody is saying that it is going on an uptrend. That is very wrong, and it can kill you as a trader. So you understand? So most technical trading strategies are still based on this assumption that prices moves in trend. So most profitable traders, they follow the current trend of the coin that you are trading, of whatever thing you are trading, whether it is forex, whether it is crypto, whether it is stocks. You follow the trend. You don't trade against the market. You don't predict. You react to that trend. Then when we say history tends to repeat itself, that is another important idea in technical analysis. It is that history tends to repeat itself, mainly in terms of price movements. The repetitive nature of price movements is attributed to the market psychology. In other words, market participants tend to provide a consistent reaction to similar market stimuli over time. That is the way human emotions does not change. The same way they react to things is the same way they still react to things over time. It does not change. Unlike technology that advances, human emotions does not advance. Once your emotion is there, your emotion is there. It does not change. So whatever reaction that a particular person reacts to this particular trend now is the same way he is most likely to react to that trend later on. So technical analysis can be used on anything: stocks, forex, crypto, everything, futures, commodity, everything generally. So that is just the basics regarding all this assumption. That is just the basic philosophy regarding technical analysis. We'll get into the how it works subsequently in the remaining set of classes that we'll be having. So I think that is just all regarding the basics. Yes, then as I was saying, furthermore, when we look at the difference between technical analysis and fundamental analysis, we call it TA and FA. You'll be hearing it everywhere. TA is technical analysis, FA is fundamental analysis. So there are two different schools of thoughts in the financial market, as I've explained before. Technical analysis basically looks at the price movement of whatever you are looking at. It could be stocks, it could be forex, it could be crypto, and use that data to predict the future price movement. While fundamental analysis, on the other hand, it looks at a lot of factors, basically the economic factors, which is known as the fundamentals. So when we look at fundamental and TA, as a fundamental analyst, if you are looking at crypto now, you first of all look at the white paper, you look at the all-time high, all-time low. If it is a new coin, you look at the white paper, you check the use case of that coin, if it is something that a lot of people will buy the idea and all those stuff like that. That is what a fundamental analyst will first of all look at. But a technical analyst will first of all look at the chart, look at the previous price movement of the chart. We call it price actions. So that is what a technical analysis will first of all look at, while a fundamental analysis will first of all look at what people are saying about it, what and who are contributing to the creation of the coin. What are their plans for the marketing and everything? That is what a fundamental analyst will most likely first of all look at. Sure, you understand? Because the technical analyst will be like, there's no reason to analyze the company's fundamentals since they are all accounted for on the chart. Sure, you understand? So they believe all the information they need is already in the chart. But fundamental analysts will first of all look at a lot of factors before buying into the idea. But a good trader is supposed to blend the two together. You are supposed to blend the two together. While you're analyzing the chart, also look out for news, important updates regarding that coin that you're analyzing. It is also important because there are some news that affects the market. Whatever happens in FA will still eventually reflect on the chart. But if you are blending the two together, you'll be in the know-how that this thing is happening, it will affect the price movement of the chart. Then you look at how it is going to affect it, whether it is positively or negatively. Positive news usually pushes the price of the coin to the upside in an uptrend, but negative news actually pushes the prices of coins to the downside. We call it downtrend. So in as much as you're a technical analyst and you are analyzing the chart, you're also expected to at least have a certain knowledge of fundamentals of that coin. Probably any news that is coming up or stuff like that. It will actually help you to be profitable. So you understand? And FA, they usually do more of long-term approach. They buy down a coin long term, 3 years, 5 years, 10 years. But TA, you can analyze a coin within 15 minutes and enter the trade and leave the market within 5-10 minutes. But a fundamental analyst will never do that. So you understand? So it is subjective. Whichever one you want to go into, it is subjective. And the different indicators and everything, it varies. It just depends on the one you are comfortable with. You don't need to copy anybody's style. Create your own. Find out what works for you. Then that is when you can now perfect everything. Then I think that is all regarding that. So in technical analysis, there are a lot of things involved, a whole lot of things, and I already explained to you in the course outline. Candlestick pattern, support, resistance, trend line, demand and supply level, and the likes. It is so many, and even the advanced other blocks, liquidity, area of value, point of interest, everything. It is enormous. So you need, even after learning everything, you still have to unlearn, then find out the ones that work for you. If you don't practice, you can never ever understand all these things. If you don't perfect it, or practice it rather, if you don't practice it, you won't really understand it. And that is just the bitter truth. That is just the bitter truth regarding this. So lastly, in summary of everything I've said so far, technical analysis is basically a method of evaluating the market by analyzing statistics generated by market activities. It is based on 3 assumptions. 1, the market discounts everything, price moves in trend, and history tends to repeat itself. Technicians believe that all the information they need about a coin can be found on the chart. Technical traders takes short-term approach in analyzing the market, while fundamental analyst takes a long-term approach in analyzing the market. And criticism of TA stems from the efficient market hypothesis, which states that the market price is always the correct one, so making any historical analysis useless. That is to say that nobody father owned the market. Market can change, a trend can change at any fucking time. So even though history repeats itself, nobody's father owns the market. The market can change anytime. And one of the most important concepts in technical analysis is trend, which is the general direction in which a coin is headed, the price of a coin is headed. And there are 3 types of trend: uptrend, downtrend, and sideways or horizontal trends, which we call consolidation. Then we would look at trend line. Trend line is just a simple charting technique that adds a line to a chart to represent the trend in the market. Then we have channel 2. A channel or channel line is the addition of 2 parallel trend lines that acts as a strong area of support and resistance. Like I said earlier, support and resistance are the most important thing for you to understand perfectly as a trader. Support is basically the price level where a coin randomly falls back to. Then resistance is the price level that a coin most times do not surpass. That is, whenever it gets to that place, it comes back down. And support is whenever it gets to support, it goes back up. It's very straightforward. Then volume is basically the number of contracts that's the number of, how will I put it, the amount of trades over a given period of time, and it is usually calculated every day. So the higher the volume, the more activity revolving around that coin. Then a chart is basically a graphical representation of a series of prices over a set time frame. Then the time scale refers to the range of dates at the bottom of the chart. You see it there: daily, weekly, 4-hour, quarterly, and annually. You see it there. When we get to time frame analysis, we'll talk about that very well. Then there are 4 main types of charts used by investors and traders. We have the line chart, we have the bar chart, we have the candlestick chart, and the point and figure chart. But the most important ones that everybody generally uses is the candlestick chart. So on the trading view that we did today, that we set up today, as you can see, it is candlesticks that we'll be dealing with. We'll be basically dealing with candlestick patterns. So a chart pattern is a distinct formation on a coin's chart that creates a trading signal or a sign of future price movement. So we read charts to foresee the future price movement, and there are basically 2 types. We have the reversal and the continuation. When we get there, we'll talk about it. And we have different chart pattern. We have the head and shoulders, we have the cup and handle pattern, we have the double top, double bottom, we have the triangle, we have the ascending and descending triangle, we have flags, we have pennants, we have wedge, we have a gap, we have triple tops, we have triple bottoms, we have a rounding bottoms, and we have moving average as an indicator. It is the average price of a coin over a set period of time. And there are 3 types. We have simple moving average, we have linear moving average, we have exponential moving average, and we have so many indicators too that either lead or lag you. We have the accumulation and distribution line, which is a volume indicator. You see it at the bottom of your chart. It's usually there. So we have the accumulation and distribution. We have the MACD as an indicator. We have RSI. We call them technical indicators. We have the moving average, we have RSI, we have so many. We have OBV, unbalanced volume indicator. We have the stochastic oscillator. It is so many. We have the Aron indicator. We have the ADX, average directional index. It is so many. So when we get there, we'll talk about it. But basically, this is just the introduction part, and we'll continue from candlestick patterns from tomorrow. And that will be all for now. Good night, and God bless us all.
Follow me for more educative contents like this.